Good afternoon, everyone. Welcome to yet another interesting session from YLC, IMA. So today we are looking at a very interesting session around demystifying financial statements. I have over, I think, about 114 odd participants already joined us. And let me start with a brief intro of myself, and then I'll introduce our guest today, guest speaker. I'm Santosh. I currently work as vice chairman IMA YLC. Apart from that, I also head innovation and investments for a global bank in India. That's my day job. But apart from that, I'm pretty much involved in various other activities within YLC, and would love to have more and more of you to keep joining us and support us for our various sessions and also join hands in local chapters, right? I welcome you all again back to the session, and I have Sushrit Chitale. Right, Sushrit Chitale, thank you so much for joining us, sir. And what can I talk about Sushrit? Right, Sushrit is a dual rank holder, I would say, with 29th rank at CA final examination and a second rank holder all India level at ICWA, and is also a lawyer, right? I mean, what a deadly combination, sir, to have you here with that
Thank you,
kind of a
sir.
background. Right. So a bit more about Sushrit is Sushrit has been an elected member of WIRC, which is the Western Regional Chapter of CA Institute. He's also been selected as 40 under 40 under the alternative investment profession. So which means that he can speak on the spectrum of from investment to financial statements. But what I want to caution you all is that today's session is not going to be covering about the stock market. We're not talking about investments. We're not talking about alternative investments. The idea is today's session is to essentially give you all some tools and tips and techniques to understand how to look at the financial statements, read about that, get a bit of understanding of what numbers to look at, what ratios to look at, what do they, each of these terminologies mean, and then we can bank upon Sushrit's expertise to delve deeper into each of these concepts, right? Thank you so much, Sushrit, again joining for this session, and I would love to have you uh, probably elaborate a bit more on your background. On what all you have done in terms of your career. It will be lovely to have that information as well. Thank you, Sushrit.
So, thank you, Santosh, for having me here. Thank you, YLC, for hosting me. My name is Sushrut Chitaya. I'm a partner with a CA firm called Mukundem Chitaya and Company. As part of my day job, I'm a chartered accountant. Naturally, I'm an auditor of a few companies. And I also undertake due diligences on behalf of private equity funds when they invest in various companies. So that also gives me really a different perspective to looking at the financial statements, but from an investor perspective also. I mean, having said that, like Santosh clearly stated, I'm definitely not an expert in investing and definitely not an expert in the stock market. So I would rather focus the discussion in terms of trying to help everyone, or I think trying to help even myself in terms of how better to read financial statements and sort of discuss what is it that financial statements really mean and what is it that is contained therein. So I think that that's what we would rather focus today. Thank you.
Wonderful. And I also read that, Sushit, you are also part of a couple of boards and as independent director. So are these listed companies? And maybe if you can elaborate, what does that role mean actually, like as an independent director?
Yeah, so I mean, an independent director is a company law requirement, and the independent director, when I sit on a board, essentially it's a requirement as per Companies Act. But at the same point of time, I'm supposed to protect the interest of essentially all stakeholders, not only the shareholders, but ensuring that the corporate governance in the companies where I am sitting as a board member is maintained as per law, and I think more than that in spirit also. And I think that's a bit of a onerous responsibility, which a lot of people do. I mean, I've been fortunate to do it with respect to two companies.
Thank you so much, Sushrit. And that's essential for everyone to understand that independent directors are a very, very important part of the whole ecosystem, I would say, for any board. While other board members would have a certain penchant towards managing a certain aspect of the business. Independent directors, as the name suggests, are very, very independent. They are not tied down by any of the growth trajectories that the company or the other board members are looking at. Their role is essentially to build in the best governance that the corporate can really put across. And governance is essentially a key part of ensuring that none of the scams that emerge, and also ensure that the individual retail investors are protected in the larger sense, right? Thank you so much, Sushruth. Let's start the session. Let's demystify. I hope all the participants and delegates are excited to join us today. My first and primary question is that as a student of accountancy, right, during my own bachelor's degree as well as my at my IIM Bangalore days, I mean the fun element was this used to be a dreaded subject. So all of us used to get scared on all the terminologies, all the jargons that gets thrown at us. And so there's this cash flow, there's balance sheet, there's P&L, there's trial balance, right? So why don't you help us start with demystifying each of these terms, right? What do they mean? What's the background to that?
Absolutely. Let me just put it in the context of maybe a listed company, because I think for all of us, what we can easily see nowadays is to download an annual report of a large listed company by just going on their website. And I'm just taking an example so that it is easier to sort of relate, because I mean, otherwise, financial statements in India or the financial statements are required to be presented and audited in respect of every company in India as per law is concerned. That includes private limited companies, public unlisted companies, as well as public listed companies. Now, just for the sake of simplicity, if you download any listed company's balance sheet today, or what we call typically the annual report. Now, nowadays, the annual report you can also call, I mean, people also call it an integrated report because it also contains information about a host of other elements, including sustainability. But typically, if you look at any annual report, there you can say there are broad three components therein. One is what are called as statutory reports. Now, what could these statutory reports typically be? It could include the management discussion and analysis, wherein the management typically talks about what has happened in the year gone by and what they expect to happen as far as the next year is concerned. Second is the obligatory requirement called as the board's report to the shareholders, in which there are specific information which is required to be given by the board of directors to the shareholders in terms of information about a host of. Third is a report on corporate governance. Now, corporate governance has been a element which has been introduced by SEBI as far as all listed companies are concerned, and hence all listed companies need to follow a set of norms prescribed by SEBI to ensure that they are governed properly. So there is a report to that. That is a report on corporate governance. A recent addition to the whole thing is what is called as a business responsibility and sustainability report. So in common parlance, it is called BRSR. On the global forum, what has happened is over a period of time, people have started speaking that instead of looking at only profit, we should look at a triple bottom line. This triple bottom line is essentially three P's, which includes people, profit, and planet. And hence, while financial statements will always give a unidirectional or a unidirectional perspective to the whole aspect, the whole discussion around sustainability, or what we call as ESG, has been to look really focus on the variety of aspects or the variety of ways in which a typical business affects the environment around it. So it includes people, it includes obviously the profits, because that's what investors really care about, frankly, at the end of the day. And also, what is the impact on the planet in terms of the environment or the ecology around. So from that perspective, SEBI over the last 1 year has made BRSR reporting compulsory for the top 1,000 companies by market capitalization. And if you look through this report, you will get a lot of information in terms of how each company is trying to deal with issues like diversity in terms of employment, uh, sort of treatment of sewage or treatment of effluents, and a lot of other information. So I think BRSR is one aspect of, again, the statutory reports. And the last part is the CSR report also. I mean, CSR report is the corporate social responsibility. We all understand in India, as per law, 2% of the net profits has to be spent on corporate social responsibility. And accordingly, a report is typically given in any annual report which contains the actual information which is spent. Now, these are all statutory reports. The second broad head under any annual report is the financial statements. Now, financial statements will typically consist of the audited financial statement, that is the auditor's report on the financial statements and the financial statements itself. And these are again required to be presented on a standalone and a consolidated basis. Now, that is where I would say that the jargon starts and the complication also starts. So, for the sake of simplicity, and I mean, maybe I may just probably for some professionals here, this might appear to be like a very basic thing, but I think in the interest of everyone, I'll just try and make it a bit simple. Uh, every company in India is supposed to get its accounts audited. And at the same point of time, there could be situations that a company also has got numerous subsidiaries. It may have, what is a subsidiary? A subsidiary would be a situation where a company owns another company or has more than 50% of the shares of another company. Similarly, a company might enter into a joint venture with another company, or a company may have a significant ownership in another company. So, for each of these, the accounting standards or accounting norms prescribe a methodology of consolidation. So, for example, if I am company A and if I own more than 50% or say almost 100% in company B, then since I have the authority as well as the ability to control the operations of the other company, the law states that you consolidate the numbers of both these companies and present a picture together. So that is typically called as consolidated financial statements. And if you happen to read through the financial statements of very large companies, just to take names for the sake of example, say a Reliance Industries or a Larsen and Toubro, or maybe any of the Tata Group companies, or say a Grasim, you will realize that the standalone financial statements show one number, and the consolidated financial statements are show a number which is significantly larger, for the simple reason that these companies over a period of time have been conglomerates, and accordingly they have been owning shares of a large number of companies. So I think that's broadly about the standalone financial statements and the consolidated financial statements. Coming specifically to what are these financial statements per se. So, if you look at any financial statements broadly, to set the discussion rolling, any financial statement typically has a balance sheet, which is a statement of the financial position as of a particular date. Then there is a statement of profit and loss account, which is essentially what an economist would call these two as a stock and flow account. So similarly, in case of a PNL, it is more of a flow account, which talks about the movement of income and expenditure for a particular year, which really highlights the profit for that particular year. The third broad statement is the statement of cash flows, which really highlights what is the movement of funds which has come in and movement of funds which has gone out. And then there are notes to accounts which help us in understanding those financial statements. And last is the audit report. So I think that is broadly the breakup in terms of the financial statements. And coming back to the annual report, we spoke about the statutory reports, the financial information, and the third part is the other aspects, because in certain cases nowadays management also gives additional information with respect to performance by various types of capital, be it intellectual capital, or it could be property rights, or a host of other things. So even that kind of information is given in addition.
Wonderful. Thank you so much for the detailed walkthrough. So I remember, I think it was somewhere in mid 2000s that Infosys started reporting their human capital into their balance sheet, right? So I think there was a very remarkable look there to say that I'm not just valuing my resources in terms of tangible, intangible, but I'm also looking at my human capital, because that essentially is what is pushing my company forward. I'm also going to value them, right? Is that getting reported today? Is that an acceptable norm?
See, what has happened is, okay, uh, typically, let me put it in a very simplified jargon. The financial statements historically have been only about money, or it has only been about finance, for a primary reason that that is something which everyone can count and everyone will know the value at the same level. So, for example, if I pay you 100 rupees, then it is my expenditure and you may earn 100 rupees as income. So, from that perspective, there cannot be a difference in terms of how do we value this transaction. Accordingly, the whole background information with respect to financial statements has evolved on the basis of historical cost, that is, on the basis of actual transactions that have materialized. And accordingly, there has been a tendency to always record transactions which are financial in nature. Now, the challenge, okay, so that really highlights why financial statements talk only about essentially financial information. Now that brought about a discussion which tried to say that okay, but what about my human capital? Because I mean, for a company like a Infosys or a TCS or a Wipro or a Persistent, essentially it is people which matter. Frankly, for any business today, it is only people that matter. But I mean, for especially software services, it is people that matter. So from that perspective, they said, ki, okay, today my entire people cost is really being booked as an expense, but it should really be an asset. Now, while the concept is correct, the problem happens when you start quantifying that number. And there are obviously certain methods to quantify it. But at today's level, we can say at the most that it is quite subjective. So even from an Infosys perspective, you will say, and Infosys has actually been even presenting their economic value added even for a long time back. But all of that is in more in terms of additional information that they try to provide to the shareholders, in addition to the information in the financial statements that they are anyway providing. So I think this is, you can say, more of work in progress today, which probably will evolve over a period of time in terms of certain standards of how different companies are supposed to present it, so that it can lead to some kind of comparability between, say, a TCS and a Wipro and an Infosys as far as the same parameter is concerned.
Awesome. I think that was very interesting when I saw that being announced. It sort of shown the spotlight on a very interesting aspect of the whole business, right? Thank you for taking us through that journey. Uh, let's roll back a bit more, and maybe if I want to really further simplify each of these financial statements, right? Let's do a rapid fire. Let's try and make it simpler, because I think the audience has a mix of experienced professionals as well as people who are really looking to understand these concepts, right? So let's, for the benefit of the audience who are looking to learn about this, let's simplify. I'll do a rapid fire with 4 or 5 terms, one liner on each of them. What's a cash flow statement?
Okay, cash flow statement really highlights the movement of cash in a business during the year. Broadly, if you flow statement, it will consist of cash flow from operating activities, which is the core business per se, cash flow from investing activities, which is essentially the investments which are made by the business in the year as far as, say, capital expenditure and other things are concerned. And third thing is the cash flow from financing activities, which could be money borrowed or money raised through equity as well as loans repaid. So the sum total of this will essentially be the difference between the bank balance at the beginning of the year and bank balance at the end of the year. I mean, for all of us, including me as chartered accountants, uh, frankly speaking, this is the only and the real statement to watch out for.
Got it. Got it. Got it. So we'll keep an eye out on our cash flow statements. I mean, even as individuals, so let's keep an eye out for that. The second one is the difference between P&L and balance sheet.
Absolutely. So, I mean, let's understand one thing. Business is always a running concept.
Hmm.
So business never stops. But what happens is there are multiple reasons for which we need to take stock as of a particular date. And that is where the concept of a balance sheet originates. So while the business always continues, on any particular date, when you stop and say, okay, where do I stand as a company or as a business? That is essentially a positional statement as of a particular date. That is called a balance sheet. So put it in very simple language. Balance sheet will always be as of a particular date, whereas profit and loss account will be for a period. It will be what is it that I've earned and what is it that I have spent over probably the last 3 months, 6 months, or 1 year. That is typically a profit and loss account.
So can I simplify that and say that balance sheet is accumulation of multiple P&Ls over the last whatever number of years? Is that how
Yes,
to look at it?
in a different perspective, definitely yes. It is a sum total of what you have been doing over from, say, day zero till where do you stand on day wherever you are looking back.
Got it. Okay, and let's talk about in maybe in a line, we have GAP for the global practices and GAAP, and what's the Indian equivalent to that?
Yeah. So I mean, just before, because gap also is like a very
Okay.
technical jargon. But let me put it in this context again. I mean, why is even such kind of things required? Because
Hmm.
typically when you say accounting, we need to understand that worldwide accounting follows a basic norm called as a double entry system of bookkeeping. And when you say double entry system of bookkeeping, it means that every transaction that happens, it is accounted for in terms of a debit and a credit. So it is like something very loosely said, it is like a binary format 0 and 1. Similarly, there will always be a debit and a credit element to every accounting transaction that actually occurs. Now, based on that, a balance sheet is prepared, a PNL is prepared. Uh, this is prepared as per certain norms. Now, these norms have evolved over a period of time. These are called as generally accepted accounting principles. In an Indian context, these norms, as far as listed companies are concerned, follow the global norm. Now, the global norm is called as International Financial Reporting Standards, that is called IFRS. In an Indian context, we call it IND AS. So initially, we used to call it accounting standards. And then when accounting standards were converged with IFRS, these in an Indian context are called Indian accounting standards, which is IND AS. So I mean, let's just forget all the jargon. In essence, the norms which are to be followed globally as far as measurement, presentation, and disclosure of financial statements are concerned, are supposed to be consistent. And why is it necessary to be consistent? Because you can't have a situation like, for example, say a TCS or a Infosys, which might be also listed on a NASDAQ, to say that my profit in India for the same period is X. But for the same period, if I present my profitability as per international norms, then that profit number changes. So I think that cannot happen. And that's why countries around the world sat together and they've decided to have a common framework in terms of how accounting is to be done and how numbers are to be accounted for, so that the profit across regions, the method of computation of profit remains same, so that it leads to better comparability of financial positions and companies across the world. And at the same point of time, for a same company, it can lead to better comparability across countries and across time periods.
And if I may further that, I think it also helps in better comparison of companies in different segments and sectors, so that you can put them on a single pedestal and see how each of them are performing. Is that a right way to look at it?
Definitely. Because I mean, though the necessary elements or I think the typicalities of each sector will always change, uh, the following of a generally accepted accounting principle definitely gives comfort to the individual shareholders also, and to most of us, even as investors, that what has gone into preparing as far as the financial statements is concerned, somebody has followed those norms, and there is also a set of auditors who have verified it and found it to be appropriate.
And would these accounting standards differ from sector to sector, or are they equally applied to all sectors?
No, accounting standards are same because accounting standards are more in the concept of principles. So
Mm.
these are more principles about how a revenue should be accounted, how certain expenses should be accounted, how to recognize assets and liabilities, and how more information can be given. So I think these are more principle based. Accordingly, there for very, very typical sectors, sometimes you might have a separate accounting standard, but more or less the accounting standards being more of principle in nature, these are same as far as any sector is concerned.
Great. Now help us understand the difference between an accountant and auditor.
Oh, thanks. I mean, that's important because, frankly, these are again two different hats that probably in today's parlance most people wear. Because I mean, these are typically this is a job being done by mostly chartered accountants. So chartered accountants are primarily accountants. So the job is to finally do accounting. At the same point of time, as per law, chartered accountants have been given a unique privilege of being auditors. So chartered accountants can practice and they can audit the financial statements. In fact, it is something which only CAs are allowed to do in India in terms of doing audits of financial statements. So chartered accountants are supposed to, I mean, so when you say accountants, accountants are supposed to actually prepare the financial statements, and auditors are actually supposed to go and check whether the financial statements are actually prepared properly. And based on that, the auditors will give an opinion on the financial statements. Typically, if the auditors don't have anything adverse to comment, in such cases, you will say that the accountants in their audit reports say that the accounts show a true and fair view of the financial statements. Now, why really true and fair? Why not true and correct? For the simple reason that accounting also has become complex. The number of transactions that need to be verified in today's complex companies, I mean, for large banks or for larger companies, the transactions themselves might be millions and billions a year. And accordingly, it might not really be possible even by using different kind of technology for the auditor to really verify everything at percent level. That's why the concept is that the auditor is supposed to ensure that the fairness of the presentation of financial statements is maintained so that materially things are correct, instead of giving a complete assurance that everything in the financial statements is bound to be correct. So let me just reiterate, I'm not trying to say that it's essentially trying to say that that would mean that certain things are incorrect, but it could mean that there could be certain errors which are immaterial, and accordingly it does not really change the picture that is shown in the form of a balance sheet. So I think that's broadly what an accountant does, and that's what an auditor also does.
So could I rephrase it and say it's an acceptable level of variation that uh, can pass through,
Absolutely, absolutely.
right? Okay. So how does an auditing process work given in a financial year that we run from April to March? When does the audit start?
Yeah. So for again, take the example of listed companies first. For all companies whose equity or debt instruments are listed on a stock exchange, uh, take the case of equity. SEBI mandates that all these companies have to prepare and present their financial results for June, that is for the June, September, and December quarters within 45 days of the end of the quarter. So typically, if you're talking about say 30th June 2024, then by 15th August 2024, any company will have to present its financial results. Now, accordingly, the audit of such financial results, typically these are audited or limited reviewed as it is called, then these numbers are presented within 45 days. So the auditor will typically have to start work immediately as soon as June quarter gets over, or typically in the last week of June itself. So that's the schedule with respect to the first three quarters. For listed companies, for the whole year financial statements are concerned, SEBI mandates that within 2 months of the end of the year, that is by 31st May, the financial results for the whole year need to be published. So in that case, the audit typically happens in case of listed companies right from March up to May. Now, this is for listed companies. In case of unlisted companies, the AGM typically has to be uh, done within 6 months of the end of the financial year. So the annual general meeting for any company has to happen by 30th September. Most companies will have a notice period of almost 21 days notice to be given. So even if theoretically, let's say that the AGM is going to happen on 30th September, then in that case, the notice will have to be sent on 9th September, in which case the audit frankly has to be over before 9th September. So I think that's broadly the you can say deadlines or the way in which the auditor community is actually supposed to finish the audit.
Correct. While while there are these deadlines, but we also have seen in the news earlier that the filings could get delayed. Are there penalties for the company as well as auditors? Or like, how does that function, right?
Yeah. So, I mean, for the auditors per se, there are no penalties unless it is very obvious and clear that the company was ready with the financial statements and the auditors, for whatever reasons, were not able to complete the audit. I think that is when probably the auditors can be made accountable. But typically, every company, like I said, if it is a listed company, then it has to follow the norms of SEBI. For other companies and including listed companies, everyone has to follow the norms given by the Ministry of Corporate Affairs. Uh, if the company is unable to file their financial statements, then they are supposed to approach the registrar of companies and seek for an extension, which sometimes is given. And accordingly, then the companies are expected to file it within the extended period of time. In fact, uh, Companies Act 2013 brought about quite significant changes. One of them being that if for 3 years, if you just don't file anything, I mean, then the government also has a right to just strike off the name of the company itself. So, I mean, one request here would also be that while listed companies will always follow a certain norm because there is too much regulation around them, there is a possibility that smaller companies might take such compliances in an easy manner, which can turn out to be quite dangerous. So, if you are running a company, make sure that you follow the process, follow the law properly, and ensure that the accounts are audited latest before 30th September.
Point noted. Right. Now, who appoints auditors, and is there a conflict of interest because the company is paying, and you're evaluating their uh, accounts or financial statements, and then you're creating an opinion on that. So, can you elicit some data on
Yeah.
that?
So the auditors are technically appointed by the shareholders.
Mm,
So if you look at the entire concept of audit, an audit always presupposes three parties.
mm,
Then audit will presuppose three parties. So for example, if I am auditor, I am actually working on behalf of the shareholders of the company, and the shareholders appoint me to look at the financial statements which are prepared by the management of the company. Now, this is typically the model which will always work in case of listed companies, because in case of a listed company, the difference between the management and the shareholders is quite apparent and clear. So the management or the board of directors are the ones who are running the day-to-day functions of the company. Uh, these people are actually in charge of preparing the financial statements. But as an auditor, I'm supposed to comment on the financial statements for the benefit of the entire shareholder community at large. So it presupposes a three-party relationship where I'm always voting. I'm always working on behalf of the shareholders, and
mm.
accordingly, the company in a way pays for me. So when I say company, technically there is no conflict because indirectly it is the shareholders who are paying me through the company uh, for my services as an auditor. So as shareholders nowadays, so I think all of us are shareholders in many companies, and because of NSDL or CDSL depositories, most of the voting also actually happens online for many of these proposals. So I would say that as even retail shareholders, one should actually exercise the right in terms of trying to see the quality of auditors, have your opinion on that, and definitely participate in the voting, because having a good set of auditors and independent auditors is also as much necessary to ensure that you get the correct picture which emanates out of the company.
Awesome. So far we've touched the broad horizontal understanding around the basics of financial statements, the different components of financial statements, and some bit of regulatory compliance and dates around that, right? Let's do a double click and go deeper into each of them. And while doing that, could you also keep in mind that some of our audience today and largely at YLC also have a lot of SME businesses part of it, right? So small and medium businesses, independent run or individual run entities, partnership firms are also part of it, not just the listed companies, it could be also private limited. With that kind of a perspective is what I want to double click now to go into interior aspects of financial statements, right? What's a current asset versus current liability?
Yeah. So when we look at any balance sheet today, you will see that a typical balance sheet has two broad sides. So one is what is called as equity and liabilities,
Mm,
and the other side is called as assets. So there is a clear formula as far as the balance sheet is concerned that assets minus liabilities is the equity. Now, which
mm,
clearly means that I have certain level of assets in my hand. There is certain obligations that I have with respect to settling against that. So these are the liabilities. And the balance is typically what is called as a equity or a net worth. Now, this is how the balance sheet typically tallies. So if you see the two sides of a balance sheet, always have to tally. Now, within each of these, there are headings called as non-current assets and current assets, and non-current liabilities and current liabilities. Now, what is this non-current and current? Now, to in a simple language, you can look at it this way, that anything which can translate into actual funds within the next 1 year is called as current. So for example, there is an inventory. Now, inventory by logic has to be current because you can't have an inventory which you expect to sell after 5 years, because then what kind of business will you be in if your inventory can't get sold? Similarly, most receivables need to translate into less than a year. Your cash and bank balances are always liquid, so they are current. So these are all your current assets. Similarly, On the liability side, you could have non-current liabilities. Suppose you have taken a loan for maybe next 10 years. Now, what is supposed to be repaid in the next 1 year, that is the current maturity of that long-term loan, is something which is more of a current liability because I'm supposed to repay it in the next 1 year. But the rest of the things are something which are of a long-term nature. Accordingly, these are more of non-current liabilities. Similarly, if you have any trade payables, so whatever you buy material, now that is something which has to be paid immediately over the next year. That is called the current liability. So when you look at as a SME or any businessman, what really matters is the current assets and the current liabilities. And the difference between the current asset and the current liability is what is loosely called as what is working capital. So now this is something which is there in your business. Now typically this working capital will be funded by some kind of a bank through a cash credit or a overdraft or such kind of a facility, because this is a net balance in your balance sheet that you need to fund somehow to be able to manage the mismatch in the balance sheet. But to put it again in context, current assets is something which gets translated into cash. Cash, when I say cash, it nowadays means only money in the bank, so in money in your bank account. And current liabilities is an amount which you wish to pay in the or which you have to pay immediately in the next 1 year. And accordingly, that is current asset and current liability.
Brilliant. So essentially, for me as a business owner, I have to keep my eye out to look at what is my working capital availability, and if I don't have it, then obviously I need to look at propping it up through either borrowings or through my own investments or through other
Sources. Yeah.
investments that can come in, right? Other sources. Now, let's try and move into that thread of borrowings, right? How does a business raise money, right? We know that we can obviously get in partners and equities there, but when I go to a bank, the banks evaluate the financial statements, and that evaluation is slightly different from how I would evaluate, right? As an individual owner of a business, or it could be as an auditor who looks at the statement. So is that a fair statement to say that the bank's look evaluation of a statement is going to be slightly different from the general evaluation?
Yeah, so I mean, when an auditor really looks at it, an auditor doesn't look at it with any particular lens or a purpose. The auditor is only concerned with respect to understanding whether the presentation of the numbers is appropriate or not. So the auditor is not really concerned with any end result out of those numbers. Uh, he is only concerned to ensure that the numbers which are presented, are they correct, are they true, they are fair. That is, if you go with a balance sheet to the bank, now typically the first thing that the bank will try and understand is, do you really require the funding? So the bank, in addition to what you actually look at from your financial statements perspective, will also try and understand whether your business is something which actually requires that kind of a funding. And then accordingly, they will cross check with their experience of how a typical balance sheet of that particular sector should be. How does your balance sheet compare? And if you go to any bank, there will be broadly, to put it in very broad terms, there will be two types of funding. One is funding of a long term nature, which we typically would call as a long term funding, more so for capex purposes, for capital expenditure purposes. Now, which is where they would try and understand the project, try and understand the capital expenditure to be done, try and understand what is the kind of returns that you expect on the projects, and based on it, whether you will have sufficient cash flows to be able to pay the EMI. So I think that is typically what the bank will do. In case the other type of funding, which I would say most SMEs will typically be looking at, is the cash credit or the working capital funding. In which case the bank tries to see what is the total working capital currently locked in the business. Say for example, how much is there in inventory, how much is there in trade receivables, versus how late are we paying the creditors, based on which what is the total gap that I need to really fund, and accordingly that the bank will make that appropriate decision. Now for all of these, again, the bank also has got various norms, especially with respect to the number of days for which they can fund. For example, if you have trade receivables which are more than 90 days, then the bank will say, okay, in that case, there is a possibility that there could be delinquency, there could be certain receivable that will not be coming. And accordingly, the bank has some internal norms in terms of the total amount of money that they are finally willing to spend. But to put it in a nutshell, that is how the bank will really look at it.
Right. So they look at solvency, they look at business requirement, and they also look at the repayment capability
Absolutely.
in a sense, right? Uh, Great. Now we've understood some components of the financial statement. So, but uh, uh, I've read that ratios are the best way to analyze financial statements. Right? It sort of gives more color to the numbers there. It helps me understand and helps me in comparing different financial statements in toto there. So, what are the key ratios that we have to keep in mind as business owner, as also when I'm learning and educating myself on various other financial statements?
Absolutely. I mean, some of the key ratios that I would always speak about. One is the current ratio that you actually spoke about. What is the ratio of my current assets to my current liabilities? So that is what is the current ratio. To put it very generally, a current ratio of say 2 is to 1 is considered very good, provided that current assets also includes your bank balance. And over a period of time, if your bank balance component in your current asset is very strong, that naturally means that you are sitting with a good amount of money in your bank balance in your bank. Accordingly, your position will naturally be good.
If
Now,
I may stop you there, I just want to double click there. Isn't it uh, not a good practice to keep money in the bank? I would rather want to be investing my money, right? Why would I want to keep more money in my bank?
absolutely. Now, that is actually a more fundamental issue because if you are a company, so again, I mean, in fact, you raised a very big issue, which may be just digressing from the topic a bit, but fundamentally for any SME, MSME, I think the fundamental thing to understand is that the business, while you could be the one who is a proprietor or a partner or sometimes a owner of a private limited company, and the approach could be, yes, sab mera hi hai, but it is necessary to always have that discipline that what is it that the business requires and out of which I would be getting some money which could be in the nature of a profit or a salary or whatever, that should be determined separately. So it is always necessary to have that discipline to say that the business requires this kind of a money, and then I will be drawing only a particular amount every month which will be in the nature of a salary. Having said that, if a business has got good enough finances, then accordingly the business requirements can be seen, the business can be expanded, and so that decision can definitely be taken. I mean, for most MSMEs or for most companies, there is rarely a situation that one is sitting with too much funds lying idle as far as the bank account is concerned. So it is good to have that discussion, but I think that's not really the case with most companies for a variety of reasons. But coming back to ratios, I think that is current ratio is definitely one of it. Next is the debt equity ratio. So what is the total debt that I have compared to what is the equity that I have? Now, debt could also mean what are the total borrowings that I have and compare it with my own net worth. And if that ratio again is too high, that means I've leveraged too much. So that is again one thing that one has to be very careful about. You cannot have a debt equity ratio of say 4 is to 1 because it means that your total borrowings are very, very stretched in terms of your ability to repay. Third, what is also very important, which also goes through this, is the debt service coverage ratio. Now, how is the debt service coverage ratio calculated? It is your operating profit, that is your profit before accounting for the depreciation and finance cost. So basically, the cash profit that is available to you before paying off the lenders divided by the finance cost and plus principal repayment. So, to put it in simple language, this is how much are you really covered in terms of paying your EMIs. So, what is your profit before payment of EMIs divided by the total amount of EMIs for the next 1 year or for the year gone by? And that is where you will see that, okay, this is the kind of buffer that I really have. So, I think that's more of the debt service coverage ratio. Then the return on equity is also very important because all these ratios talk about operational efficiency. Return on equity is an important ratio which talks about whether I'm actually earning something which is good enough. Because if my total net worth base is say 5 crores, but I'm earning hardly a profit of 5 lakhs, then that means I'm earning only 1% return on my total net worth. So then that is something which would be considered as quite low. Next is the inventory turnover ratio. So how often does the inventory churn during the one financial year? So it is typically the inventory held upon sales. So if you have a high inventory turnover ratio, it is typically considered as good because that means that for you are able to rotate your inventory very fast. Your ability to liquidate your inventory is high, and which is good for any business. Same happens with the debtors turnover ratio. So the debtors turnover ratio means how quickly are you able to convert your receivables into money, into cash. And accordingly, if you have a higher debtors turnover ratio, it is considered good for the business. Next is naturally the profitability ratios. The important ones are called as the PAT, the PBT, or the EBITDA. So whichever way you want to decide profitability, that as a percentage of revenue, that is the ratio that one should look upon. And last, one more thing which I would say when you're analyzing any balance sheet, one should always look at, and this will not be a ratio which anyone else will give you, but I think with experience I can share that always look at the operating cash flows and compare it with the operating profit. So when we look at the cash flows, there is a cash flow from operating activities. Look at the cash flow from operating activities and compare it with the operating profit of that business. And then once you see that ratio, try and compare it for a long number of years. Because over a period of time, these should normally intersect. In certain years, one could be high, in certain years, the other could be high. But if you see a clear trend that there is a clear demarcation that your cash flow from operating activities is always low, but your operating profit is always high, then it would very clearly mean that there are a lot of non-cash items in your profit and loss which are not getting converted into cash at all, and which could be a red flag reading of financials are concerned. But I think from a general reader's perspective, the earlier ratios that I spoke about, these can definitely be looked at.
Great. I mean, there's so much more to learn about these. Towards the end of this conversation, you mentioned that the red flags, right? So I want to double click on that and try and understand why do accounting frauds occur? I mean, if there are accounting standards, if there are auditors who are independent and third party who are doing that, and then the whole world is looking at the accounts of a listed company, or even every stakeholder is so glued into the business. Why and how does the accounting frauds occur?
Absolutely. Uh, I mean, typically the purpose of any audit is to give a reasonable assurance that things are broadly correct. So the challenge with auditing in today's context is that the transactions are so voluminous that it is sometimes quite impossible to actually verify all the transactions. That is number one. Secondly, it could be very similar to saying that it is also very akin to saying that if there are doctors in a hospital, why should deaths occur? So, let me not offend anyone here, but what I'm trying to say here is that sometimes the corollary doesn't really work exactly right. But what I'm trying to say is that the purpose of an audit is not really to identify or to detect frauds. The purpose of an audit is to really see whether the financial statements show a true and fair view. Now, having said that, I am not in any way trying to justify a wrongdoing probably by any auditor who was completely negligent in terms of identifying frauds, because as far as the revised responsibilities that auditors have to also bear in mind, auditors are also required to look at the possibility of existence of fraud. So it is not that the auditors are supposed to see that there could be a fraud in every transaction, but the auditors have to be aware that there could be certain kind of frauds. In fact, Companies Act has now made it mandatory for the auditors to report the fraud to the government. So time has come. The situation, or you can say the laws have come a long way, whereby now as auditors, we have to actually report if there is a fraud. Then the auditors are supposed to report the fraud directly to the central government. So I think having said that, this is still much of an evolving area, because what is called a fraud today uh, is something which may not turn up into fraud as far as the criminal prosecution is concerned. And at the same point of time, I think it is quite fair to say that when people actually end up losing a lot of money, especially in the stock market, and that has been based on incorrect reporting on financial statements. Uh, I can very fairly say that in each situation it should be seen independently. What was the role of the management and what was the role of the auditor, and in which situation did the management fail more and which situation was the auditor completely negligent.
Alright. A last question around that is, uh, I mean, in a way, it's related there, but it can also be very genuine where we see something on balance sheet versus off balance sheet, right? So there's a lot of dressing that could happen. Uh, how much if it is allowed, not allowed? If you have some thoughts around that.
No, no. So I mean, window dressing is okay. That's a term which is typically used. It's called window dressing. It is trying to show numbers which are really not the case, but it is trying to show a better position than what actually exists. Now that, frankly speaking, from an accounting standards perspective or from a gap perspective, is very difficult to do. Having said that, there could be certain elements on a balance sheet which could actually be off balance sheet. For example, there could be something called as contingent liabilities. Now, suppose there is a court case. Say the GST department has filed a court case against a company based on a particular liability. The GST department is filing an appeal and trying to lay a penalty of, say, 1 crore rupees on a company. Now, the company is fighting it out. It will fight it out right up to the Supreme Court, and the company clearly believes that this amount is not going to be payable. In such cases, the accounting standards allow that this 1 crore rupee need not be accounted as a cost, but it can be shown as a contingent liability, saying that if tomorrow the court case goes against the company may be responsible to pay 1 crore rupees, which is the penalty charged by GST department. And accordingly, it is presented so that a reader can form a view appropriately and decide for himself or herself what would be the impact on the financials if this 1 crore was actually, if it was actually to crystallize. So there could be certain elements like contingent liabilities or capital commitments, which are technically not accounted, but these are disclosed separately as off balance sheet items.
So should one, while reading these financial statements, also keep an eye out for these off balance sheet items and uh, relook at, are these camouflaged or are these acceptable norms to be in the off balance sheet?
I think in such cases, mostly, I would say readers will have to uh,
Use their
place
own
their judgment
judgments.
on the auditors, because it will be impossible for a lay reader to understand whether this should actually have been accounted for. Because, say, a simple case like example that I spoke about, say a GST department notice or I mean some case which is going on. Now, as auditors, we tend to read through the entire case, and at the same point of time, we read through the entire lawyer's opinions on that matter to really come to a view whether that needs to be accounted for as an expense or it can be shown as a off balance sheet. Now, that much data is never going to be available to any lay reader. So, I would say in such cases, if they are audited, the readers can definitely place reliance on the auditor's view taken.
Thank you so much, Sushruth. I'll take some questions from the audience. So there's one interesting question by CA Mayur Jadhav. And this is more technical, I would say. Current changes in CARO 2020 and Schedule 3 about propriety aspects, right? How do we handle them in audit, like Benami property, revaluation, willful default, or utilization of loan proceeds, and investment and loans to be related party at an arm's length? So is there any view that you want to share here?
Yeah, yeah. So I mean, I'll probably just answer it in a broader concept, Mayur, because the audience here is quite general. If I go into technical aspects, this can be like a very different discussion. The point that he has tried to raise is very relevant. Uh, CARO is basically a company's auditors report order, where the Companies Act specifically requires auditors to give answers to a set of questions. Now, over a period of time, these questions have evolved depending on certain frauds which have happened, and based on which today the Companies Act requires auditors to answer certain questions very specifically. For example, they ask a question: how many properties are there in the books of accounts where the Schedule 2 or whatever is the land record does not give the name of the company as owned? Now, there could also be situations like there could be certain companies where the ownership is there with the company for last 100 years, but you might not be able to really find a title deed, but at least that comes out. Secondly, how many companies or how many properties could be there which are covered by the Benami Property Act? So I mean, there are a lot of information which is now required to be given as answers by the auditors, which really helps the company. Or, for example, a very relevant thing and which is good, which has happened. is that now auditors are supposed to very clearly state that is there a difference between the amount which is disclosed to the bank and the amount which is there in the financial statements. So I think that was again a very big gap, but now Companies Act specifically asks us to report that. So I think let me just answer it in that context.
Great. So the next question is around again a bit I would say technical there. So what is other comprehensive income and what's the difference between fair value through P&L versus fair
Okay.
value through OCI?
Okay. Again, this let me just, it's a good question. Considering the flow, I did not go too much into the technical aspects. Let me explain in very simple English. Over a period of time, what happened is that people realized that the entire focus was on the profit and loss account. And accordingly, the balance sheet was not really presenting the real financial position from a earnings perspective. Say, for example, you take a Tata Steel balance sheet. Now, a Tata Steel balance sheet with so much land in Jamshedpur brought 100 years back. Today, you can imagine what would be the value of that land itself. Now, what happens in such cases? Now, do we need to really revalue the land? The answer, one can say yes, you might probably show a correct picture of what should be the financial position. I mean, because I am interested in understanding what is the current value of my assets. But then the next question arises that if I show that current value, what will the impact be? Because if I've accounted it for say at 10 lakhs, but today the value could be say 1,000 crores, then the difference, can I call it profit? Then people said, no, 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 that can't be profit because that will lead to wide fluctuations in annual incomes. So that is where this whole concept of other comprehensive income came about. So this other comprehensive income is, in a loose way, you can say, something which helps the balance sheet to be stated at its correct realizable position, but taking away the bad part of that volatility from it so that it is shown separately under a different head called as other comprehensive income. So what could go in other comprehensive income? It could also be certain elements like defined benefit plans. So in case of larger companies where pensions are paid, every year there are actuarial valuations done, which changes the pension liabilities and corresponding assets. Now the difference in that per se has really nothing to do with my operating position as a business, in which case that difference is typically adjusted in what is called as a fair value through other comprehensive income. At the same point of time, there could be certain debt instruments. Now, debt instruments, I might decide at some point of time that I have only held it for sale, I might, or held it for investments. At some point of time, I'll say that I now transfer it to held it for sale. And accordingly, at which point of time I might transfer the income from OCI to FVTPL. But again, I think I'm getting a bit more technical. But essentially, as a concept, other comprehensive income is an essential part of every balance sheet. But one thing we should always remember that the profit which is considered for EPS, earning per share, is always before other comprehensive income. So even if the other comprehensive income looks very high, the earning per share is always calculated on the basis of profit after tax, which is the operating profit for the company. So because that again, typically from a market's perspective, everything is on a PE multiple or a price earning multiple, for which the earning per share becomes a relevant criteria. That is always going to be before the other comprehensive income.
One last question I'll take up is a lot of businesses are today looking global. So there's either export import or you may have source of funds outside, you may have assets outside. How does accounting standard recommend to take, or what does accounting standard recommend to take as my FX conversion number? Right, if it's INR USD, what date should I take? The date of transaction or the date of accounting?
Yeah, so I mean, again, there are detailed rules with respect to that in terms of the broader context. If you are doing a transaction, typically the rate when you do the transaction will be accounted for. If the transaction remains open at the end of a financial reporting period, suppose you do a transaction on 28th March, then when you do a sale, it will have to be done at the date when you do the sale, when the goods actually move out. But the receivable is something, if it remains as of 31st March, then you will take the rate as of 31st March with respect to the receivables. And accordingly, the difference in this is called as foreign exchange fluctuation reserve, which will have to be again accounted for more so in terms of your other comprehensive income or the PNL as the case may be. And accordingly, that will be out, it will be accounted for.
Thank you so much, Sushil, for taking questions. So we are right on dot at 5:30. I tell my audience, if you have any further questions, please do drop an email to us at ylc@ima.in. I request that someone from the organizing team to please drop that email ID in the chat window. We'll be happy to take those questions, and Sushil will be helping us out with answering those. Again, thank you so much, audience. We have about we at the peak of it, we had about 215 audience, and who were really keen to understand the demystification of financial statements. So, Sushil, it was a wonderful session, and I think the whole flow that we went through a very broad level understanding of what each of the larger financial statement or financial components are in the statement, and then we double clicked to understand the nuances inside each of these, ranging from the ratios to understanding how my working capital has to be evaluated, and also we took different lenses coming from the bank versus an auditor versus an owner of the business. So this, I think, is a good stepping stone for a lot of us to really go and enhance our knowledge. And thank you so much for joining and sharing your knowledge, Sushrit. It was a wonderful session.
Thank you, Santosh. Thank you, YLC. Thanks for the opportunity. Thank you so much.
And thank you, audience. It was great having you all and have these interactive questions out there. A lot of other questions are unanswered, I would say. So please do drop in an email to ylc@ima.in. I'm happy to coordinate and get those answers for you. Just ensure that don't ask any investment suggestions from us. So that's not the intent of the session, as I said earlier as well. So we're looking at answering those questions which are more related to demystifying the financial statement, and give us a couple of days. Our team at the back end will be helping you out, and I'd love to have those audience who are not part of YLC to please come and join us as members. There's a tremendous amount of benefit that you can derive as members, and also join hands at your local chapter to run events and get to meet people at the professional level and build those professional connects. Thanks so much, everyone.